Hello folks, this is episode number 14 in a continuing series of 20 videos for the Optimal Trade Entry Pattern Recognition series for the Inner Circle Trader YouTube channel. Alright, so our example for today is the British pound. We already have our chart trained in on the 5-minute chart, you know the drill. Pause your video, study it before I show the annotations. Okay, here we go. We have our New York session again, always 8:30 to 11 a.m. New York time. And this is our optimal trade entry. Now I'm going to go over a couple in here briefly, but this is the one that I would use. This is how I teach it in my mentorship as well. The selection of this particular swing is, again, it's a little bit of a finesse type thing, but I want you to, now that you see this here, I'm going to take it off for a moment just so you can see. When you're looking at your chart, it's going to look like this unless you have other things over top of it. And that's why you don't want to have indicators, you don't want to have trend lines, moving averages, none of that stuff, okay, because it's going to be a distraction. You want to be looking at the time of 8:30 to 11, and when the market's showing a strong willingness to go lower. Now this is obvious a reversal, and if you look at my Twitter account today, I actually show a recording of me highlighting this turning point here on the British pound at this order block and running up above a level, which it does here. I was given that as an indication to study that, and it was highlighting this movement here, creating a Judas swing and then ultimate breakdown. When we entered the 8:30 to 11 a.m. New York time, that's our New York session, time of day for this model I've created for YouTube. And what you're looking for is a price swing that's very clear, that has a clear indication that it's trying to drive lower. Okay, in other words, there's a very quick, like, underlying pressure for the price to go lower. It's a lot of back and forth in price action. It creates that little trading range here, that little square block area here. This, notice the difference between all of these down close candles versus this in here. It's a little muddy. Okay, in other words, it's not as clear. Yes, it does decline, but it just seems like it's a lot more uncertain in this area. Whereas if we have this swing high, we have this lower high to the right, and this one single candle here, that to me, with this real clear indication I want to move lower, that's the price leg that I'm going to elect to use. And if you go back and look at all the examples we've been doing in this series, they all have very similar characteristics to this very thing here. So it's not a matter of going back in and cherry picking which one looks better, which one looks perfect, whatever. After you do this for months, you're going to see it's the same signature all the time. And now what is a signature? A signature is something or a characteristic, okay, that the markets give us as price action traders that we're looking for to repeat over and over and over again. So if there's something to a market that creates a certain phenomenon, it should have a lot of reoccurring instances of, I guess. So what I'm teaching in this series is the repeated nature of this particular pattern. All you need to do is determine whether you're going to be trading a run below yesterday's low or above yesterday's high. And I've already shown you a continuation pattern using this same thing with a market that's already gone beyond the previous day's high or low. And you can still use this model to practice and grow in your understanding with price action. So with that said, all of this in here is the price leg that I would use and how I teach it. So it's very clear. It's showing a displacement. Okay, very clear, obvious movement lower. The market comes back up, trades into this high, but not all up into it. So we'll add the fib back to it again. And again, the fib is not the magic. It's not, trust me, it has nothing to do with why price is going up there. The fib is just allowing me to frame a market that is really overbought without having to use any overbought or oversold indicator, because I'm showing you the range of this high to this low. So when price traded back up to here, if we look back inside that range, we are really near this high. So technically that would be a short-term overbought market. That's all the fibs helping me illustrate. And then the Fibonacci projections, okay, all these levels down here are just rough ideas how far the market could go. But again, we're linking that with the previous day's low in this case here. And then you can see the previous day's low. We do trade down into it. Now, the details are we always look for the 62% retracement level. That in this instance would be a hypothetical entry of 1.2268 and 1 pip at. Using a 20 pip stop loss, that would take us above this high. No real jeopardy in terms of being stopped out. You do have 7 pips drawdown. Again, we're always using the 62% retracement level. You can finesse your entry and try to use the 70.5 level or the 79% retracement level, but as I mentioned in previous recordings in this series, you're likely to miss the trade or the dealer spread may not be covered for your entry to fill. So again, we're using the low-hanging fruit approach, as I like to teach in my mentorship, where it's really, really easy to get the 62% retracement level and not always the 79. Everybody wants to sell at the highest levels. That way their stop loss could be smaller, but you don't need to do that. And especially when you're learning how to use the pattern. So the market starts to show a willingness to drop lower. Right down here, we have about 20 pips or so at just the old low. So right away you can bank something there. And at 1/2 of a standard deviation, you have about 40 pips that you could potentially bank there hypothetically. And then ultimately down to 60 pips, which runs the previous day's low. So all in all, we have a 3-to-1 reward to risk if you like to look at those types of things. I think it's really not necessary, because if you have a high strike rate method or model, and I know some of you that are learning, or maybe some of you that really like to look at these types of things and say this is what has to happen for me to take a trade, you can make an amazing career trading 1-to-1 if you have a very solid strike rate. And clearly, as I'm indicating in these examples here, this pattern works every single day. It's there every single day. And the problem that's going to plague you is determining whether you want to be a buyer or seller. And I know what you want to ask me if we were in a chat room together, okay? Or if you were talking to me directly through Twitter, or if you emailed me, because I get this email a lot. Can you just tell me how to determine the bias? And I'm telling you again, it's always the same response. Number one, it takes a lot of other supporting lessons to get good at the bias. Now, I could tell you things, and I've done a lot of that even in free tutorials that's on this YouTube channel. But it takes you getting in here and studying every single day, screen capturing your charts, and doing the annotations yourself, and getting used to what the pattern looks like. And it sounds like it should be just tell me how to do it one time and it works all the time. It's not like that, because if it was just that easy, believe me, everybody would be out here doing it, and they just don't do it. So this is one more example in the continuing series. Hopefully you found it insightful. Until next time, I wish you good luck and good trading.